Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Gosh, we've got a lot of things to talk about. We're going to start off with, should the United States delist Chinese stocks? A lot of talk about the Chinese, what's going on. We're going to talk about delisting their stocks. Job openings. Well, they look like a problem on the surface, but we'll go a little bit deeper into those to see what's really going on behind the scenes there. Also going to be talking about the jobs report that came out on Friday. More evidence that the economy is in good shape. We'll discuss that as well. And then lastly, but not any least important, maybe even more important, are we in the middle of a recession or not? It kind of looks like, oh my gosh, the GDP report. We'll dissect that for you and talk about it. And Chase, what companies are we covering today?
Yeah, companies we're looking at, Zimmer Biomet, Take-Two Interactive, Northrop Grumman, and then Alphabet as well. Got a full slate here. Excited to break down the fundamentals, valuation ratios, balance sheets, giving you an idea if we think it's a buy, sell, or hold based off the numbers that we see here on air. So got a full show. Let's get to it.
Let's get right into it because there's about 286 Chinese companies listed on the major U.S. stock exchanges. And some of the names you'll kind of recognize like Alibaba, Baidu, JD.com. But there is some concern. Should they be here in the United States and should people be trading those stocks? It does benefit the Chinese government actually. Should we get rid of them on our New York Stock Exchange? That's a question, big question.
Yeah, it's a big question that I think a lot of people have, and you know, I'm going to say I'm a capitalist. I think they can be on there. Yeah. But I personally, we do not invest in any Chinese companies. We'll kind of get into that. But one thing that we found very interesting, and this was actually estimated by analysts at Goldman Sachs, and it was that U.S. institutional investors currently own about $830 billion worth of Chinese stocks. And I'm going to say really no surprise here, but that is more than 2 times what the Chinese own of U.S. stocks, as that is estimated around $370 billion. The thing that we look at is, I know people personally that are invested in Alibaba. I know it's a well-known company that people are like, oh, it's like the Amazon of China, so I'm going to buy that as an opportunity. The problem is, I mean, a quick sell-off could really bring down the stock valuations and then make it difficult to get out of many of these stocks on both sides as well.
You know, you mentioned that Chinese own about $370 billion of U.S. stock. At first glance, I'm thinking, well, wait a minute. They got 1 billion people versus our 360 million people here. Maybe that's a correct number. But we do have much higher per capita earnings. So that could be the reason why. Because at first I'm thinking, well, that's terrible. It should be more than twice. But it's not. Could be. There's probably, I think actually they don't have more billionaires than we have. Not yet.
Gosh, I forget the number. I know
Hard
we did a
to
post
count
on that a while ago.
Yeah.
But I mean, I do know that the wealth concentration there is much different. There's still a lot of poor areas in China.
Yes.
I'm going to say I believe. I don't know the exact numbers on that,
Right.
but I'm quite confident that the wealth disparity there is much more problematic than it is here.
I kind of got on track on that because I wanted to talk about the Accountable Act, which came out in 2020. And this allows the SEC, the Securities Exchange Commission, to ban foreign companies from trading on the American exchanges and regulators if they're not allowed to inspect the companies. And this can go on for 3 years in a row. And I'm pretty confident there are some companies that the regulators have not looked at for 3 years in a row. I remember looking at this, I want to say 6 months, a year ago. There were some companies that said, yeah, we need to get on this because I worry about Chinese companies because it's not a free country. The government, if you don't like what the government does, they tell you, no, you put down that you made $1 a share. And we talked about, was it LinkedIn Coffee, I think it was? Lincoln Coffee. Luckin?
Like ducking, but luck.
Oh, I was going to say like luck to have, but LinkedIn.
LinkedIn.
Okay, whatever it was.
Whatever.
Point being is that they had terrible numbers and they were hiding them. So I'm kind of, and I know some people probably want to invest in Chinese companies with the growth. Are you looking it up right now? Is that what you're doing?
Yeah, that's bothering me.
Okay. But it's just something that there are things that need to be done. They need to follow our rules. And if they have not been audited in 3 years and those numbers aren't correct, I say get rid of them, kick them off.
Yeah, and I think, just to be clear, that Accountable Act was a great thing.
Oh, yeah.
Because, as you said, luck in coffee, it is.
I'll get it right. Don't worry.
There were some big issues there, and I think having us go in and audit these Chinese companies is so important. And the scary thing is there have been some Chinese companies that delisted themselves rather than go through an audit. And I'm like, whoa,
what does that tell you?
That is a big problem. And the way I kind of view this is, if these Chinese companies are willing to go through an audit and they go through those standards, I don't have an issue with them being on our exchanges. Again, I'm not going to invest in them. We like to still invest in U.S. companies here. But I think as long as that transparency there, I don't have a problem with it.
Right. And I don't think that the Chinese businesses use GAAP accounting. I know there's some international accounting that they may use, but it's still, I've said this for years. I like GAAP accounting. I understand it. That's why we don't like investing in foreign companies, because we don't know what their accounting is. They're not ruled by GAAP, which is generally accepted accounting principles.
I think there's a whole host of reasons why I wouldn't invest in Chinese companies. I talk about the accounting, but also, too, I have some big concerns about their economy moving forward.
Oh, yeah.
And a lot of those companies, their revenue, their sales are concentrated there. And people are like, oh, there's 1 billion people, so it's a great opportunity. Again, I still worry about the economy growth rather than the massive size of the population.
Yeah.
And I think there's some big concerns. So, if you own Alibaba, Baidu, JD.com, whatever it may be, just be careful.
Yep. Let's move on to job openings, because there seems to be some problems on the surface. And the March job openings, which is the job openings labor turnover survey called JOLTS. So we like that. It showed the job openings was totaled 7.2 million. Now, first, like, oh my gosh, it dropped from 7.5 million. We're having problems. The estimate was also 7.5 million. So it looks like, oh, this is not good news. There's not as many jobs open. But there's a lot more to this report than just the numbers.
There's a lot more to it. And the thing that we look at is the economy, the labor market. It's been so strong that we've kind of gotten, I'm going to say lucky, we've kind of gotten naive, I think, to the way that numbers should look. So we kind of look in pre-COVID, because COVID distorted a bunch of these numbers. In 2019, job openings averaged approximately 7.2 million. So again, right exactly where they were in March.
And 2019, great economy.
Great economy. 2018, I'm going to say a good economy as well. Job openings averaged 6.8 million approximately. 2017, they averaged approximately 6.2 million. So we're decelerating, we're softening, but we're coming from such a high level that I'm going to say it's not overly problematic.
And I think the number is, correct me if I'm wrong, but I think there's still like 1.3 jobs opening for everybody looking for jobs. Is that the number? Do you have that? I didn't see that this time.
I know it had fallen, I think, to like 1.1.
Okay.
But again, anything above one is, I think, still very good.
Still a good thing. Still positive there. So another thing I like about the report is the quits ratio of people quitting jobs. And this one surprised me, because the total quits of people quitting was 3.3 million. That was a quit rate of 2.1%. The reason why this is so important to me, why I look at it so closely, if you are concerned about the economy, you're concerned about making your house payment, you're concerned about your car payment, you are not going to be quitting your job. You're going to be saying, no, I'll do whatever you want, boss. I'll stay as long as you want. But people saying, no, I'm going to quit because I'll get another job in a couple of weeks. I'm not worried about it. And what is amazing is that the quits averaged about 3.5 million back in 2019. Again, going back to a very strong period. So 3.3, 3.5. Please, we're not in a difficult economy at this point in time. Quit ratio back then was 2.3%, but still.
So we're right in line where we were. But back in 2019, there wasn't the same level of concern, which is why we wanted to kind of pull these numbers in. And kind of to add to your point about you're not going to quit your job if you're worried about the economy, for two reasons. Well, one, you need that paycheck to pay for things. Number two, if people, you can't find work out there, there's no job opportunities. Why would you quit your job if you don't think there's another job opportunity out there? I think this is just, again, showing the panic that is maybe not really there yet.
Right, exactly.
And we did want to say as well, just another point, this JOLTS report, it's not just job openings. We talk about quits. The last thing in this report is layoffs. And this amazed me because in the report we saw layoffs, they remained quite low at 1.6 million. Again, looking at 2019, layoffs average around 1.8 million per month in 2019. So 1.6 million versus 1.8 million. And again, people in 2019 were not talking about layoffs. They were not talking about the unemployment situation as being a problem like they are today. So just kind of looking at these numbers, hopefully it gives you a little bit more comfort in where we are at in this labor market.
And there is no doubt there is uncertainty remains, and that will have some impact on businesses and their hiring plans. We do see them now like, well, I'm just going to wait a little bit longer, see how this whole tariff thing lays out. But in terms of pushing the economy into a major recession, I just don't see it. We're at a healthy level. We've compared for you. 2019, when you're not worried about anything, so why worry now? And like, well, but this could happen. But right now, the data's saying, no, things are pretty good.
And we'll kind of talk about this, the labor market details in terms of new payrolls that were created, new jobs that were created. But in these job openings, the quits, the layoffs, what I think you're going to see here is I don't think you're going to see mass layoffs. I think companies are just going to kind of pause things. I don't think they're going to accelerate hiring, but I don't think they're going to necessarily decrease hiring drastically either. I think with these tariffs, the uncertainty, most likely things are just going to kind of be on pause.
And that's why at our firm, we do spend, we'll say asset management, we spend a lot of time looking at this data. We share it with our listeners, our viewers, everybody else, because it's so important not to make emotional decisions. And if this data changes, we'll let you know. We'll say, yeah, we're a little bit worried, but right now the data is showing no need to worry at this point in time. And then, go ahead.
I was just going to say, it's so funny. I always tell people, I want to be very clear. I mean, these tariffs, these trade talks, I'm not saying short-term they're good for the economy, but it's just not as bad, I think, as the media makes it out to be.
Exactly. And then we'll move on to the jobs report, which shows more evidence the economy is in good shape. So another reason for you not to panic. U.S. non-farm payrolls, they grew by 176,000 jobs in the month of April, which was well above the estimate of 133,000 jobs. That really surprised me. That was way above the estimate. Healthcare, which we like healthcare, did add 51,000 jobs. And employment and transportation, warehousing, financial activities, also strong, adding 29,000 and 14,000 jobs respectively. Other categories like construction, manufacturing, leisure, hospitality, and retail trade saw little or no change in payrolls, but they're still not big declining, which is good. And things are still, with all the talk you hear, the negative talk, the numbers are telling you something completely different.
Well, and especially this is now in the month of April. The JOLTS report lagged. So the JOLTS report was from March. This was from April. So, I mean, this was post a lot of the April 2nd news and a lot of April 2nd concern. And as I said, what kind of happened? Little to no change. So kind of a stabilization, essentially, except for healthcare. And the other big one people talk about is government. I mean, government declined by 9,000 jobs in the month, and they are now down about 26,000 since January. But the important part you have to understand here, and we talked about this before, is that employees on paid leave or receiving ongoing severance pay are still counted as employed. So what is likely going to happen in this government industry sector, whatever you want to call it, in the labor report, that is going to continue to see declines as people start to come off that severance pay. I think you're going to see this decline happen, June, July, August, September, October, November. I forget exactly how long this carried out and as part of the Doge layoffs.
Right.
But you're going to see declines in government employment, I think, for the next 6-7 months.
I don't know about other people, but I like to see the government spend less money, have less people working for them. To me, because that just maybe they could reduce the taxes if they get because there's a lot of fluff there with the government and people working there, and also too expenses. So
yeah, and I think it's. Especially the big thing is if they can be picked up in the private sector, because net, if somebody loses their job in the government and they can't find a new job, that hurts the economy. But the hope is that the private sector can then pick up the lack of government hiring or the government layoffs so that people still have a job and they can contribute to the economy.
Yeah, I think you and I have talked just off air different things about, we see in some places you go, there's more administrative people than there are of the people they're serving.
Yeah.
And it's just like, that's not good. So at Wilson Asset Management, we try to be very slim and,
efficient.
Efficient, yes. We like to be efficient. So do want to just change gears real quick. I just talk briefly about the inflation front, because we also got good news with that, with the average hourly earnings rising just 3.8%. Why is that good? Because it's a good increase, but it doesn't put pressure on inflation like when wages back in 2022, when they rose 5%. That is wage inflation. That's a problem. So people getting to earn a little bit more without having wage inflation pushing prices up even more.
Yeah, I think overall this was a great labor report. And as you said, we're going to keep our eyes on the future labor reports. But I think this one, we got the data here. We're going to say I got my stamp of approval on it, and we'll see what it looks like next month.
Yep. Let's move on to the GDP because people were saying, oh, see, we're in the middle of a recession. The things look bad. The first quarter GDP came in, actually declined 0.3%. And there's three different numbers. This was the advanced number.
Yes.
And I forget I know there's a final. Do they call it the one in the middle? The middle?
Preliminary? I forget. I but I know, there's three readings.
Three different numbers. It was 0.3%, which can change. A recession, this is the problem. Generally defined as 2 consecutive quarters of declined GDP. So people saying, see, things are getting bad, already down for the first quarter. But again, it's just something that you have to look at to understand that we're only halfway through. This can change, and let's talk about those numbers as well.
Yeah, and the thing we look at it is, 2022 was, I'm going to say, our last technical recession. We'll kind of talk about why that is. But what happened in 22 is we did see 2 consecutive quarters of declining GDP as Q1 declined 1.4%. Q2, the advanced estimate showed that there was a decline of 0.9%. As we kind of talked about, things can change as these numbers come out. And by the time that we have now kind of analyzed that Q2 GDP from 2022, well, actually it shows there was a 0.3% gain in GDP. So you went from a negative 0.9 to a positive 0.3. No technical recession any longer. And I point out as well, it's like, oh my gosh, things are so bad. Are we going to be able to get through it? Well, 2022 got off to a bad start, but the year ended with a 2.1% growth rate. So things can turn quite quickly. And I think we could see something quite similar here where it's like, oh my gosh, Q1 was difficult. And again, being down 0.3% in my mind is not that bad. But things can turn where we end on a positive note. And I think that's very likely.
And we got some great data to back that up. Before we get to that, though, I do want to talk about, because we talked about the recession, what's really defined that. The National Bureau of Economic Research makes the official call on recession. And many times that doesn't happen right away. It takes some time for that to come out. And they use a much broader set of indicators. They're saying, in the 2 consecutive quarters of negative GDP is kind of like a rule of thumb.
Yeah.
It could be a problem, but it's not the indicator. And I want to say the real call of the recession comes like 6 to 12 months later. It takes them a while to do that because there's so many factors you have to look at.
Yeah, and I think if GDP, for whatever reason, slips again in Q2 and Q1 holds, but the labor market remains strong, I don't think they're going to call it a recession, especially, let's say Q1's down 0.3 and Q2's down 0.5%. And then I'm just pulling numbers out here. And the labor market, I don't think they're going to constitute that as a recession with such small declines and a positive labor market. But again, we'll have to see how that shakes out.
Some people in the mainstream media, we're in a recession. Yeah, terrible. Let's talk about the government spending because it was, and I like this.
Well, we got to talk about the consumer spending first.
Oh, I'm sorry. I jumped ahead.
That was a big positive. I'll cover consumer spending if you talk about government spending.
Deal.
But consumer spending actually grew 1.8% in the quarter as services showed a nice increase of 2.4%. Also, private domestic investment, I was shocked by this, saw a surge of 21.9%. And this was led by investments in equipment as they grew 22.5% in the quarter. So consumer spending, one thing I wanted to pull out here is services up 2.4%. We kind of talked about this last week. Yeah. But you can't pull forward demand on services. I can't go get my hair cut twice in a month and then not go get it cut again.
Do anything, but you can do it if you want to.
You can't pull forward that. You can't go out to get a restaurant and pull forward that demand. Right. So to me, when I looked at services growing 2.4%, I saw that as still a big positive. And I do think on that private domestic investment, obviously that surge of 21.9%. I believe some of that is because of that pull forward in demand. I'm not going to say no way, very unlikely that companies are like, well, things are great, we're going to go spend this much money. I think they were trying to get ahead of tariffs, but still positive. Right. Companies aren't going to go get a bunch of equipment and invest money if they're like, oh my gosh, we're going to head into a terrible recession. They'd probably just cancel that spending rather than pull it forward.
Yeah, and I was so excited about this number about the government spending falling 1.4%, which does hurt the GDP. Yeah. But I still like it because the government is, it's from the taxpayers. That's where they get their money to spend. So to reduce the spending is a good thing. It was led by a decline of 5.1% spending in the federal government. So states, they're still doing different things, but I was glad to see the decline in that. And the group as a whole ended up subtracting about 0.25% from the headline GDP number. Not terrible, but still, I would be okay with a 1% decline in GDP if the government stopped spending and reduce their spending.
Well, I mean, again, you add back that 0.25% to the headline number. Now you're pretty much back to neutral. Yeah. But the big reason for the decline in GDP was trade. Companies were trying to get ahead of looming tariffs, and imports surged. I was blown away by this. Imports were up 41.3% in Q1. I mean, that's a huge increase, especially when you compare it to an increase of just 1.8% for exports. And then the huge discrepancy caused the trade component of GDP, and this number is crazy. It caused the trade component of GDP to decrease the headline number by 4.83%. So you add that back in, now you're looking at GDP growing, actually about 5-ish%. I mean, it's just crazy. And again, a big component that domestic investment was an outlier, but the trade was an even bigger outlier to the negative side, and that really pulled the number down for GDP.
And when I saw that, remind me when you have inventory builds, it hurts the GDP, and the next time it helps the GDP. I think we're going to see that again, and I do not believe the second quarter is going to be a negative. I think it's going to be a positive because we're not going to see this. Again, 4.8% taken off of the GDP number. If that's just flat, that's going to be huge as opposed to reversal. So I was glad to see that number, and I thought it was going to be that high. I thought it was going to be high, but not that high. I was shocked on that. And then let's talk about the headline. PCE showed an increase of 2.3%, which compares to last month's reading of 2.7%. And core PCE came in at just 2.6%. Inflation is really being controlled here. Nice decline from February's reading of 3%. I believe these numbers will likely increase with the tariffs, but they're not at high levels. And I heard the president call for reducing interest rates. I'm thinking, yeah, maybe that makes sense because I think we could have a little slowdown, and we got a good jobs market. We don't have inflation. Why shouldn't we take a quarter point off?
I mean, this inflation report kind of went under the radar, I think, because of everything else happening this week. But again, 2.6% is so close to that 2% target. I mean, it is not a concern. Inflation at 2.6%, I'm going to say, is not a concern from an economic standpoint. And as I said, I mean, maybe there is some credence to starting that lowering of the short-term rates from the Federal Reserve.
Well, all this information comes from our newsletter. If you want to sign up for the newsletter, go to smartinvesting2000.com. That's smartinvesting2000.com. Other topics there you'll see, will the U.S. dollar collapse for good? What will Warren Buffett say at the Berkshire Hathaway annual meeting on May 3rd? More declines to come in the stock market? Could there be? We talk about that. And even a great investor like Warren Buffett, well, he has losing his portfolio as well. And I can't leave this one out. California gas prices, well, it looks like they could go even higher by as much as $1 because of crazy government policies. But let's go to a company now. We got time? Yeah.
Let's jump to it.
And we're going to jump right into, I'm still going to call it Google. I know it's Alphabet now, but I'm still going to call it.
I thought we were going to start with Zimmer.
Oh, well, shoot. Okay.
We can start with Google.
Well, it's up there. Yeah, let's start with Google.
Let's do it then.
We're gonna throw you all off here. We're going to start with Google. It's just showing on my screen here. So we know about Google. Alphabet. Internet company, only 0.4% short on the float side. Institutional ownership, 62%. That means a lot of people hold that individually. These numbers have come down quite a bit to where they're not good for investing yet, but looking better. PE ratio, 18.6, below the industry at 22.2. Price to sales, 5.7 versus 6.2. Price to cash flow is 15.4 versus 16.6. And price to book value, well, that's 5.8 versus 5.4. And they have a PEG ratio, very good PEG ratio, which shows what you're paying for the future growth, 1 versus 6. So I like seeing that. So in valuation ratios, you always want them lower than the industry average. We do see earnings looking pretty good, up 37.4%, which is actually very good. But the industry was up 44.5. Sales did climb by 13.1. Industry was up 4.8, so that's a positive. The 5-year earnings per share growth estimate from the analysts, they're looking for 18.2% versus 15.9. So Google, and again, still apologize for not calling Alphabet, still looking pretty good. They pay a small dividend, 0.5%. Just stop that. I mean, they use 8% of their earnings to pay that out. I don't see the point of that. Current ratio 1.8 versus 2.3. That's good. Debt to equity, very good. 0.1. Industry at 0.2. I got to be excited about their net profit margin. Yeah, very high, 30.9, almost 31%, above the industry at 20.8. Return on equity, very good, 32.2 versus 31.6. What do you got for the numbers going forward, Chase?
There's a current price here for Alphabet. Again, ticker symbol is either GOOG or GOOGL, depending on which one you want. There's two different depending on the voting class there. I forget which one is which. One you get voting rights, one you don't get voting rights. I never understand if they're equal, why you would not take the one with the voting rights, but I digress. Current price there for GOOG is $165.81. The 52-week range here is $142.66 as the low. The high is $208.70. Year-to-date, the stock is still down about 13%, so we have seen a little bit of a pullback there. And we've talked about how these Magnificent Seven companies have gotten so expensive. Alphabet is one that it's not quite a buy yet, but it is actually in our hold category based off of the estimated earnings for December 2026 of $10.19, as it would give us a target sell price of $169.15. So again, not quite at that buy level for us, but for a great company to kind of be pulling back, I mean, it's of intrigue here if it does pull back further.
And I am surprised too, looking back 90 days, the estimate for 2026 was 10.25. It's only down to 10.19, and all the stuff this company's gone through to still remain there is surprising to me. I mean, that they do have lawsuits coming up from the government, so there's a lot of headwinds for a lot of these Mag 7 companies. It's just surprising to me, and I don't know if it's going to change very quickly with the analysts, but I'm still, I like the company. I want to get it, but then in the back of my mind, I think like, who knows? They could break up the company. And I forget some of the details of the lawsuit that they're at. Kind of drag on.
It's not even one lawsuit. They've been ruled a monopoly in search, and then recently here they were also ruled a monopoly for publisher ad servers and the market for ad exchanges as well.
I did not see that.
So they've been ruled a monopoly by two different judges that they're going to have to work through. And one thing I look at with Alphabet, though, maybe breaking up the company wouldn't be that bad. And I say that because YouTube is a great asset that they own. Some say that it is kind of undervalued. If you were to separate that out, it might get a higher margin. If you look at like Netflix multiples, that might be positive for them. They have Waymo, which continues to lose money, but I think it has a huge growth opportunity there as well. I mean, you kind of get a sum of the parts equation, as some analysts call it, and Alphabet might be worth more independently than they are kind of as a whole right now. So it's an interesting story to follow here. But the big thing I question is search. That's their big asset. I don't know. I used to be kind of a knocker of ChatGPT. I use it a lot more than I actually use Google search now.
Yeah, that's because you're a young guy. I keep forgetting to do it. I just constantly go to Google all the time.
It's right there. It's easy.
But I do want to point out before we're out of time that could be why the stock is staying high, because the breakup value could be worth more. And YouTube, I would love to see the profits, because everybody knows YouTube.
They've done tremendously well. And I know we talk about this, I still think Waymo is going to be a big player here in years to come.
Why Waymo? All right. When we come back, we're going to finish up with the companies, talk about Take-Two Interactive, Northrop Grumman, and then Zimmer Biomet. We'll talk about that. Stay with us. We'll be right back. Alrighty, welcome back to the second part of the Smart Investing Show. This is where we talk about financial planning. For that, we turn to our financial planning expert, CFP Harrison Johnson. Harrison, thanks for being here today.
Always good to be here.
We're talking about today, and I like this because you see this advertised on TV all the time, the commercials, oh, someone's taking your home and you won't know it till you get the foreclosure notices. We're talking about protecting yourself from home title theft. And this is something I think, it just seems like came out like a year or two ago.
I mean, it's been around. I think it's becoming more prevalent lately. And you're right. You do see a lot of commercials about it, whether you see it on TV or the radio. So, basically it's a type of real estate fraud where somebody will get your personal or public information. A lot of the information they use to do this is public information, and they use that information, forge your signature, file a deed, and transfer the title of your property into this thief's name. And then once that happens, they on paper own the property, so they can sell it. They can create lease agreements and rent it out. They can take out loans against it, and you might not have any idea until you get foreclosed on. Someone's at your door. So
not a good feeling when that happens. Like, well, what happened? I mean, and when you see that, when it happens, is there a way to protect it ahead of time as opposed to doing it with these companies that are going to charge you, I don't know, 20, 30, 40 bucks a month?
So that's the thing. A lot of the commercials that you hear about monitoring services, so they don't necessarily prevent it from happening. It's just, if something gets recorded on your property, you get notified. So, you can be preemptive and try to stop it from happening. But these services, they are a service from a company, so they charge money. Now, this is something that we found out about fairly recently, but if you own property in this county of San Diego, Jordan Marks, who is the San Diego County Assessor, Recorder, County Clerk, his office has a free service that does the monitoring for you. You just have to sign up for it. You put in your name, your email address, and your parcel number, and it will send you an email if anything gets recorded on your property. So, I mean, if you're a resident or if you own property in San Diego, you should absolutely do this. I did this with my house. And also, if you're paying one of those services, you should stop paying that service and then go over to this because it does the same exact thing, only this is free.
And it saves you $20, $30 a month. And I got to say, Jordan he doesn't seem like a public official because he talks about customer service.
Isn't that weird?
It's just very weird. I know him personally, and it's just like when he said, like, wow, you're in government and you're customer service. But what is great is that he does these things. He did during COVID. He also did this other thing where people want to get married. They couldn't. So he did outdoor marriages at these things. And other counties followed. So I'm hoping that he's setting the bar on this as well. So people, if you're in a different county, say, well, I want to do that, but LA County doesn't do it. Well, then complain, say, well, they do it in San Diego. Because again, it's going to put these businesses out of business. Probably they're doing it.
Well, I mean, maybe because again, I think San Diego County is the only one in California that does it. So those services, they can sell to all the other counties, and that's fine. But you're right. Hopefully, this takes root because it makes perfect sense that the recorder's office could notify you if something gets filed or recorded on your property title. It's a great idea, and again, I think it's a great benefit. So I mean, we get along really well with Jordan, and he's been doing well.
Yeah, great guy, and is that a great public official? I kind of wish he'd run for governor.
He's still young. He's got a lot of time ahead of him. So
I was kind of peeking at your notes here, Harrison. I know you put on their title insurance and mortgage and HELOC. How does that relate to this topic?
So kind of in the prevention side of it, because again, what the county can do through what Jordan Marks has done, and then with the services, they monitor. So if anything gets recorded, you can be notified. You can also purchase title insurance, and that also doesn't prevent it from happening. But if somebody does steal your title, it gives you some resources so that you can battle it in court. So the way that I look at it is I don't know if that's terribly necessary, especially if you do have a good monitoring service. And then the other thing is, having a mortgage or having a home equity line of credit on your property is kind of like another layer of defense because now those banks have a lien on your property. Your title can still be stolen, so it's not like that totally prevents it, but that's also something that adds another layer. So having some type of loan or credit line on your property and then combining that with monitoring service, I think is, something that really everybody should be looking at doing.
So basically, if you have equity of, I don't know, a few $100,000 in your home, you probably want to say, you know what, I better be careful here because this could happen.
Yeah, exactly. I mean, if you have equity, this is something to be aware of. And, the FBI says it's one of the faster growing crimes out there as far as theft goes. I wouldn't say, this is happening to everybody you've ever met and, it's an absolute over control thing, but this does happen just like all kinds of things happen. And since you can do the monitoring for free, there's no reason not to do it.
It's not a problem until it happens to you.
Yeah. And then it's a huge problem. I mean, for a lot of people, their home is one of their largest assets. Yeah. So having that stolen from them while they're literally in it, it could be a huge problem, very time consuming, very expensive to deal with.
It just blows me away how awful people can be. I mean, you don't know the people and you're just going to take their home essentially, and they have a wife, kids, a family, and it's like, well, care about me.
Not only that, they take the home and then they give you debt.
Yeah. It just blows me away how terrible people can be.
And you have to pay that debt. If you didn't prevent it, you owe that money.
Yeah.
I mean, and it's just it'd probably be a nightmare for years for you to deal with.
Oh yeah. I mean, it would be catastrophic.
And I know we did it on my home as well, and I think it took 5 minutes.
Yeah, it's extremely easy. You go to the San Diego County Assessor's website. It's called Owner Alert is the one that's offered by San Diego. It takes 2 minutes to sign up for it.
And again, I'll say if you're in another county across the country, I mean, we're in many different places, go to your county assessor, say, hey, why are we not doing this? San Diego does it. Can you do it?
Yeah.
And they say, yeah, gee, never thought about that.
Right,
So,
absolutely.
yeah. Well, Harrison, thank you very much. Another great tip on financial planning that people, they go to a normal financial planner, they're not going to hear things like this, but it's something that you look at to try to help people out and have a great life because of strong, unbiased financial planning.
That's right. Thanks for having me, guys.
All right. Thank you, Harrison. Again, that's Harrison Johnson. He is our financial planner at Wilsey Asset Management. He is a CFP. If you want a free consultation with him, go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You send an email there. Or you can call him at the office at 858-224-0004. Again, that's 858-224-0004. Well, Chase, you ready to do another company?
Yeah, let's get to it.
All right, let's go to Zimmer Biomet Holdings. And this is one, I'll talk more about it in a minute here. We'll give you some numbers, but I recognize this company from years ago when it was just Zimmer. And I don't know if you have the data on that. I know you always have some good background data on stuff. So let's look at the numbers first to see if it's worth looking at a buy here. They are in the medical device services industry. Only 3.6% short on the float. That's a positive. 94% institutional owned. And we do see a PE ratio that is 23.1, which sounds a little bit high, but the industry is at 55. Price of sales, 2.7 versus 3.9. Price to book value, 1.6 versus 3.8. Price to cash flow is 13.9 versus 26.5. And again, these are valuation ratios. The lower the number, the better. They do have a PEG ratio of 2.3 versus 7.9. So that's another positive. Now, over the past year, their earnings are down 3.9%. And if I was going to invest in this company, I want to know why. What happened? Because the whole industry was up 25%. Maybe this is creating a buying opportunity. Their sales were only up 3%, industry up 12.6%. Are they lagging something? What's going on here? Also, their 5-year growth rate on the earnings is only 5.6%, which is not bad, but the industry is at 8.2%. They do pay a 0.9% dividend, use 22% of the earnings to pay that out. Taking a look at the balance sheet here, they got a current ratio of 1.9 versus 2.1. That's good. Don't see any problem with the debt. It's 0.5, same as the industry. Net profit margin looking very good, 11.8. That's above the industry at 9.1. And then return on equity, not sure why this is low. It's 7.3 versus 18. We generally like to invest in companies where they have a return on equity of around 15%. Chase, what do you got?
Yeah, so current price here for, again, Zimmer Biomet Holdings is $102.38. 52-week range. The low here is $93.10, and the high is $122.25. To give you that information on Zimmer to Zimmer Biomet, It did actually happen in June 2015. So it's kind of interesting. Zimmer did acquire Biomet for cash and equity in a deal that was valued at approximately $14 billion. So that's when they changed to Zimmer Biomet Holdings. But I say it's interesting because now that's about 10 years ago.
Yeah.
And generally, we don't like to see acquisitions of this size. It's hard to kind of integrate those companies, and generally, I'm just going to say it's a challenge. And I point this out because the 10-year return on Zimmer Biomet, negative 9.9%. So since they've kind of merged here, it hasn't been good for shareholders of what I'm going to say with Zimmer pre-Zimmer Biomet.
And I remember I liked Zimmer before because they do like knee replacements, hip replacements. I think they actually make the artificial knee, I guess I'll call it. But it was always very expensive, and that's why I never bought it. And I looked at again over 10 years ago, but it looks like something has changed. I'm not sure what Biomed brought to the table.
Yeah, I mean, I was kind of looking at some of the products. You already mentioned the knee and hip products. They also have sports medicine, foot and ankle, extremities, trauma products. Now, there's interesting face and skull reconstruction products.
Face reconstruction?
Face and skull. Yeah, so I guess
skull.
you break your skull and
okay.
maybe reconstruct it somehow.
I guess when I like their face, they get it reconstructed too.
Maybe that too. I'm not sure exactly, but then they also have something that can fixate and stabilize the bones of the chest to facilitate healing or reconstruction after open heart surgery or deformities of the chest. It then offers technology and data, bone cement, and surgical products. I mean, I think this is an interesting company, and I was blown away by this. It was actually founded, Zimmer at the very least was founded in 1927. I mean, so
Really?
this has been around for a long time, apparently.
I wonder if back then if they did like cast and stuff like that, because obviously they did not have knee replacements back then. So
Or something to stabilize
yeah.
your open heart surgery. I mean,
and I did hear you mention that they do have like some pharmaceuticals. It sounded like, I think you said, or some.
not pharmaceuticals, but bone cement was.
Bone cement
So
was
they're
one.
more focused on the surgery.
Something
of
with
it.
sports. I heard something with
Sports medicine.
sports medicine.
So likely like a foot and ankle. So they
Okay.
probably work with, athletes that maybe need to repair that knee after they tear their ACL or something. I'm speculating, but
And
it seems to be pretty broad reaching in terms of the products that they offer.
And you know why this is so important? Because pickleball is really very popular. And older people like myself play it, and they don't realize it. Their brain thinks they're young, their body's not. And there's a lot of knee injuries and ankle injuries. People that are older playing pickleball.
This could be great.
This could be great.
Yeah, and we know we have an aging population. I haven't given the numbers yet, so let me get to that. But we go out to December 2026. I see estimated earnings per share here, $8.83. It gives us a target sell price of $146.58. Again, above that current price of $102.38. Trades at about 11.5 times those future earnings. I mean, I think there's a lot to like here, and I'll give people a little secret. This is something that we actually read about recently, and I'm like, this looks kind of interesting. Yeah. I mean, it appears to have some good potential, and I'll tell you, now with the S&P 500, it's only down like 3% year to date. The NASDAQ, I think, is down 7%. Completely recovered the losses that we saw from that April 2nd, concern over the tariffs and everything. I think the markets are once again expensive. I think something like this in healthcare, I'm kind of more intrigued by something of this nature. I'm quite high on it, I would say.
And what we like to do is invest in companies. We don't trade stocks. We like, here's a great company, a great business we can get into. I do see that for the last 90 days, their earnings estimates did fall by 4%. I'm wondering if the products that they use, because they probably assemble them here, or maybe they assemble them in China. I mean,
that's a great point.
Yeah, because maybe that's why they're falling, because the tariffs could hurt their products. So if you're going to buy this company, which we will be looking at closer, you want to look to see, okay, how are these products made? More about the products, because they've got a long line of products. But I think, and again, you may buy it. What was the price? Like
146.
146. I mean, I wouldn't have a problem if we bought it at 146 and it fell to 130.
Oh, I'm sorry. That was the sell price. The current price is around 102.
Oh, 102. So what I'm saying is I wouldn't care if I bought it at 102. I wouldn't be thrilled about it if it dropped down to 90, because I think this is a business that, again, is growing, because you talk about our aging population. People, again, do have bad knees, bad ankles, bad hips. So many things this company does. This, I think, is a great long-term business for a population that is aging.
Yeah, and I would just kind of add one more potential pitfall to look at, and that's competition. I mean, you kind of brought up the growth rates are a little bit concerning, and I look at going forward, I mean, earnings growth is estimated to still be, I'm going to say, high single digits over the next couple of years. But, I mean, is there competition, and that's why the earnings and sales haven't been growing as much? I mean, that could be something of issue. Another thing we know about is a potential cut in government spending here on Medicare, Medicaid. If there are lower reimbursement rates, is that going to hurt, these, I'm going to say, elective surgeries that people can kind of opt for? That is another area where maybe this would hurt us, Emer Biomet. But overall, I like it. There's just kind of some questions I still have.
Right. And I looked at the cash flow. I mean, it's over the last 12 months, about $1.5 billion. That's very important with the company, because with competition, you again, you're going to have to, cut your prices sometimes and compete well. I don't know the other companies in this industry. I've just known Zimmer for probably 12 years. I think is probably a good time frame. But I like the business. But again, you got to check the other numbers to make sure it's good. And I was going to look at the free cash flow number. I think we have. Oh, that's the wrong thing I clicked on there. Let me see if I can find it real quick. Where's the free cash flow number? I always hate when I can't do it quickly. Well, 1.1 billion.
It's a business that I don't think you're going to see go bankrupt. I think it's very well managed.
Yeah.
I don't think, again, it's going to go from 100 to 200 next year. But I think it is. I think it's just a good, safe company that I think you can do well on.
Yeah, and I think the 5-year earnings per share growth rate is 6%, kind of on the low side.
Well, and let's even say it grows at 6%. You get a 6% growth on earnings. Let's say it maintains its multiple, which is very low, plus a 1% dividend. I mean, you make 7% per year. Now you add multiple expansion, because I think it's trading at a very low multiple. That's where you start to get now 8, 9, 10% growth on this stock because the multiple is so low. And that's why we like value investing, is that opportunity for multiple expansion along with mid to high single digit growth in those earnings.
And they did that acquisition 10 years ago. So the debt, again, 0.5 debt to equity. So that's not a problem. Now, hopefully they don't acquire somebody else as a big one. That would be an issue, but no talk on that. And that's why you do the research.
Yep.
To say, is there anything else on there? Listen to what the management. Did they just do their conference call recently?
That is one thing, actually, I messed up on when we picked these companies that time. They report next week. So I would not buy the stock until they report to get a better input of what's going on.
Yeah, because I can tell you what's going on and so forth. So we'll be listening to that conference call. Yep. So, all right, let's talk about Take-Two Interactive. This is another one, been around for a long time. I think, gosh, 10, 15 years ago, I'm pretty sure I invested in this company. Made some good money. We did?
Yep.
Were you with me then? No.
I was in either high school or college, but I was managing my small portfolio back then, and I remember looking at that and buying that in my portfolio.
Yeah, and it's still, I guess you'll probably show us what the 10-year return is. I don't want to get there, but let's talk about this company because there's some things going on here that I think had the stock pull back. Again, Take-Two Interactive is a company. It's a gaming company. Their symbol is TTWO. 5.2% short on the float, and that's not too bad. 99.5% institutional owned. That surprised me for a gaming company. I thought more people would hold that individually, but I guess not. We're missing a lot of numbers here. Did they just report? No. I hope not. I mean, I don't have a PE ratio. I have a price to sales of 7 versus 4.5. Price to book value 6.8, and then I have no price to cash flow, no PEG ratio, no price to free cash flow. So I'm missing something.
The numbers are not there, or they're negative because they reported February 6th was their last earnings report.
Wow. Yeah, they'll be reporting pretty soon here, I guess. But missing some numbers. That's not a good sign. No earnings per share growth. Sales growth, surprising, only up 1.9%. But the whole industry, well, that was down 7.4%. So that's strange. Here's another strange number. 5-year earnings per share growth rate, 124%.
Interesting.
I don't know how they could do that. So that's a strange number. The industry's at 24%. I know this is a kind of a exciting industry on the gaming side that a lot of people love gaming and stuff, and they'll pay any price for what they get. Look at the balance sheet. Current ratio 0.8 versus 2.7. Not a problem, but I'd watch it. Debt to equity looks good. 0.7 versus 1.7. Net profit margin. Something going on here, a negative 67% versus a negative 0.2%. You'd want to understand why they lost 67 cents on every dollar that they brought in. Something going on there. Return on equity, also a bad number, negative 64 versus a positive 7.1. Free cash flow is a negative 495 million versus 1.7 billion positive for the industry. So this company is going through something right now. The question is it going to be something that's going to be a short-term problem that makes it a buy, or a trend in the wrong direction? What do you got going forward?
Yeah, so current price here for Take-Two, again, their ticker symbol is TTWO. It's $219.50. And gosh, I don't know why we sold this business. 10-year return up 838%.
I kept mine. No.
And that's something, too, we tell people. I mean, being a value investor doesn't mean we're always going to be right. No. And would we have loved to hold Take-Two this whole time? Absolutely. But, it didn't make sense. And I think what happened was they had some games hit that you didn't know was going to happen, essentially. But, kudos to you, I guess, if you've held it. 52-week range for Take-Two, $135.24 is the low. The high here is $238. I was kind of looking, I mean, the big game that they have is Grand Theft Auto. And this was actually in the news on Friday. They're delaying their Grand Theft Auto release, which really took the stock down. They had previously scheduled the release for fall 2025, but it's now set for May 26, 2026. So, I mean, that is probably not something that people like to see, considering how big that is to Take-Two. They have some other games, too. I'm not a gamer anymore, so I'm not sure essentially what they are and how popular they are, but I think the one I recognize is Grand Theft Auto.
You got more, right?
I got the estimates going forward.
Yeah,
but
I'm sorry. Go ahead.
Looking at the target sell price for Take-Two Interactive, we go out to March 2026. I do see estimated earnings per share here of $7.53. It would give us a target sell price of $124.99. So forward PE is over 30 times. I mean, it's very expensive. I will say with that caveat, I think that this next earnings report is their fiscal year, so we will then be looking at March 2027. But that even still is at $9.24, which is a forward PE of still over 25 times. And the numbers here are strange. I mean, the 2025 fiscal year estimated earnings are $2.50, so you're looking to go from $2.50 to $7.53. There was some weird things that happened with the accounting of the earnings, and I'm not sure what that was, but definitely something you'd have to keep an eye on.
I think I may have bad information here from Stock Rover. They show next year, March 2026, earnings of $1.67. I think you said they were 7, didn't you?
7.53.
Yeah, I mean it's that's crazy. It shows 18 analysts, a low of a loss of 292, a high of 426. Yeah, so
I remember we looked at EA, Electronic Arts. And I was like, wow, these numbers look great. And this is probably 5-6 months ago. And then you looked at it on Stock Rover and you're like, I'm not seeing the same numbers. So I'm not sure if these video game companies, Stock Rover really hates them or what. But I mean, the discrepancy was large. I remember Electronic Arts as well.
You know, and there's 18 analysts here. Do you show how many?
23.
23. So, I mean, they're obviously different analysts.
But I mean, the low I have is $5.20.
Yeah, the low I have is a loss of 292. So, that right there would scare me.
Yeah.
Because, and I would keep watching it. You know, the Stock Rover, I mean, this is all data they just pull. I mean, nobody's sitting there typing it in. So it's something strange here. And if things don't add up, we generally don't want to mess with it. And
I would tell you, with all of this, there is no reason as a value investor to even consider Take-Two Interactive. So I don't even care about the numbers you have because my numbers are better numbers and they still don't constitute a buy.
Yeah. And that's what we're trying to do is kind of point people the right direction. And you know what's going to ask you too, we're running out of time here, but real quick, I've not seen a video game lately. I remember when you used to do it, they were kind of pretty good. They must look like
TV,
real people now.
Yeah. I don't know. I haven't bought in a new video game in 5 years.
Yeah.
So
I don't know anybody that plays video games. I mean,
there's plenty of them out there. I know that.
Yeah. Well, I wish I knew. Well, I'm going to check somebody that plays video games. I don't know anybody that does. My other son doesn't, so I don't know.
Yeah. Let's move on. We got to get to our last company.
I was going to ask our audience, but they're all being quiet. So let's move on to Northrop Grumman here because that's a defense contractor. And we try when we do these, so we try to mix them up for you so that you do have different things to kind of look at investing. And Northrop Grumman is in the aerospace and defense industry. Short on the float, 1.6%, not bad, 84% institutional owned. PE ratio is 19.4 versus 75. That's a big positive there. Price to sales 1.8 versus 2.4. Price to book value 4.7 versus 6.1. Price to cash flow 20.4 versus 28. PEG ratio not good, 8.2, well above the industry at 3.8. That's very disappointing there. We do see the earnings were up 76.6% over the last year. Industry was down 15.4. Sales only climbed by 0.6, but the industry was down 15.6. But ask yourself, how'd you grow earnings at 76% when sales were flat? 5-year earnings growth rate for Northrop Grumman is 2.2. Industry 19.6. They pay a 1.7% dividend. Use 67%. Oh no, I'm sorry, 32% of their earnings to pay that out. 67% of their free cash flow to pay that out. That's the number I was looking at there. The balance sheet current ratio 1 versus 1.4. Debt to equity 1.1 versus 0.8. I mean, we're doing okay here. Net profit margin 9.2 versus 4.6. Return on equity 24.8 versus 12.4. And I will say the free cash flow very good, 1.8 billion versus 1.5 billion for the industry. So what do you got going for it?
Yeah, current price here for Northrop Grumman. Ticker symbol here first, I guess, is NOC. That current price, though, $491.42. The 52-week range, the low here is $418.60. And the high, $555.57. It is interesting. They did report earnings last week, and on those earnings, the stock fell about 13%. So I thought, hey, maybe this is an opportunity. We've kind of looked at some defense contractors. Thought maybe there's some opportunity there. And with the pullback, I was like, hey, maybe there's even greater opportunity. With that said, the issue on why they pulled back was they said they see earnings per share between $24.95 and $25.35. Versus a previous range of $27.85 to $28.25. So a big pullback in that forward guidance, which led to, again, I'm going to say a re-rating on that stock. and a lower kind of stock price after those earnings were released. Going forward, though, to December 2026, unfortunately, I see estimated earnings per share of $28.75 gives us a target sell of just $477.25. And I say just, well, because again, that current price, $491. So we're still above our target sell price, which would not be a good buying indicator for us.
Yeah, and I wonder with this industry, what's going to happen, because again, our defense spending will still go up, but I know other countries are going to have to start getting defense spending, and they probably have to buy from U.S. contractors. So I'm kind of surprised when these numbers aren't higher, but maybe they're waiting for the tariffs to settle before they say like, oh yes, this is going to benefit.
And I saw President Trump released his budget proposal, which again isn't law, but it's right. Kind of a guide on what they want. I guess defense spending was up like 13% even in the U.S. So, maybe some opportunities within defense if you get the stocks pulling back.
Yeah. Well, there's a closing bell. I think we'll close on that. So thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, give myself a call or Chase a call at 858-224-0004. Again, that's 858-224-0004. Or go to our website, smartinvesting2000.com. That's smartinvesting2000.com. You can sign up for the newsletter there. A lot of great information at smartinvesting2000.com. We'll be back next week right here on the Smart Investing Show.